Hi, everybody. Okay, good morning. It looks like we've got most people in now, so I'm going to make a start. As I just said, good morning and welcome to this morning's K3 Hub CPD session. For those who haven't virtually met me before, my name's Marie Wadeson and I'm a Managing Director at Quantuma. And on behalf of our parent company, the K3 Capital Group, I am responsible for the K3 Hub, which is a member network for professional advisors developed by us and other companies within the K3 Capital Group. Since we launched in the spring of 2021, over 2,400 like-minded professionals from across the country have joined our network, through which they've accessed a range of CPD and training sessions very similar to today's event, and referral fees for certain types of work referred into our group. Today, we have a 3-hour CPD session on entrepreneurial themes. Before I introduce you to our speaker, we've got a few pieces of housekeeping that I'd just like to run through quickly. We are recording today's session and the webinar will be placed onto the K3 Hub website next week. Q&A function is open and I can see a few of you have used that already, so please do feel free to ask questions as we go along. Our preference is that if you do have questions, that you use Q&A function rather than the chat, just so that the lecturer today can keep on top of this. I think we've just posted the slide presentation into the chat. If that's not being done and I've missed that, then that will be done very shortly. And again, we'll do that several times throughout this morning's session, just for those people who joined late or those that didn't get it first time round. We have a number of poll questions which will be running throughout today's session. Our lecturer will lead those for us. And it goes without saying that we'd be very grateful to you for your participation. And finally, given the length of this morning's session, we do plan to take a couple of short comfort breaks, which will be there or thereabouts on the hour. Okay, so moving on to today's session then. So I'm very pleased to be able to welcome back Ros Martin, who is a regular at the K3 Hub and is our lecturer today. Ros is a consultant, a lecturer and a former Inland Revenue Inspector. And Ros actually holds the record for one of our CPD sessions, which you may not know. So more recently, she ran a session on commercial property tax, which I think was our most well attended session ever. So no pressure whatsoever, Ros, today. Today's session will broadly cover a brief update on the changes to R&D tax reliefs from April 23, patent box tax relief, the advantages and what needs to be done to meet the criteria, employment-related securities and a review of approved share schemes, the pitfalls and problems of EIS and SEIS, and finally, business asset disposal relief and exit planning for entrepreneurs. Just before we get underway, I just wanted to flag to you our next CPD event, which will be held on Friday, the 19th of May, where we'll be covering accounting and compliance for OMBs. Watch your inboxes next week for more details and your invite. And that's about it from me. So over to you, Ros.
Thank you very much, Marie, and good morning. I didn't know that I held the record, but thank you for letting me know that. Anyway, as Marie has said, she's gone through what we're going to be covering this morning. Do please feel free to ask as many questions as you want to. I will deal with them as they come in, but if I get lots of questions, then I will wait and deal with them at the end of the section. Often questions occur to people and I've kind of moved on by the time I see them, but I will keep my eye on the question box and hopefully, and as I say, please do feel free to ask as many questions as you want to. Now, Marie mentioned that we're going to be using polls. These are nothing too difficult. It's just in some ways to gauge really your opinion on one or two things. Okay, so let's start off by talking about R&D, and as Marie mentioned at the beginning, there are a number of changes in relation to R&D. Now, there are a lot of advantages to companies who have incurred R&D costs in terms of the additional tax relief that they can claim. There is a super deduction for SME companies, and RDEC for large companies, although there are some SME companies that don't qualify into the SME scheme and they can also claim RDEC instead. Now, the rates for SME companies, we will touch on these later, have gone down, and this was announced at the time of the autumn statement, and at the same time they have increased the large company rates. And that is because we are in the middle of a process whereby the government are consulting on merging these into a single scheme, and that is likely to come in from 2024. And part of the reason is that the government are slightly concerned about the amount of fraudulent activity within the R&D regime, and we will touch on that as we go through. Now, the big question that we have when we're talking about R&D is, you know, what is R&D? And actually, I'd quite like to, very early on, I appreciate, but I would quite like to run the first poll at this stage. So I don't know if that can be done. So question is are you confident that you can identify projects that might qualify for R&D relief? So if you could just answer that, that would be brilliant. Oh, that's disappeared from my screen, but I don't know if that is live. Oh, there it is. So go for it. Are you confident that you can identify projects which might qualify for R&D relief? Just give you another few seconds to answer that. Okay, can we put the results on the screen there? Again, I can't see those separately. Okay, so around, you know, yeah, 46% said no, and 22% said don't know. That is interesting because I think that what is R&D is a really interesting point. The legislation effectively says anything that's treated as R&D under GAP, but then there are guidelines issued by government department. It was the Business Enterprise Innovation and Skills, but I think that may well have been split now. Oh, sorry, somebody said RDEC, the Research and Development Expenditure Credit. It is the, we'll talk about that in a minute, exactly what that means, but it is the relief that is available for large companies. So basically, the guidelines published by the government talk about projects seeking to achieve an advance in science or technology, and that means advance in knowledge or advance in capability. Now, the guidance is written in very high level terms, really. And I do have to say that it is one of those areas where I do think taking specialist advice can be quite important. I'm currently dealing with a case where the revenue have, or I was asked for advice, I should say, on a case where the revenue have been challenging whether overhaul of a website did qualify for R&D relief. And the claim had been submitted by the accountant. They had provided very little detail, and in fact that detail that they had provided was actually unfortunately really quite unhelpful in terms of being able to convince the revenue that you know, that this was actually R&D. And so I do think it is an area where actually seeking specialist advice is useful in a lot of cases, and I do know that there is someone associated with the K3 Hub that does help with that. So when we're looking at R&D, there are certain categories of expenses which qualify for R&D, and this slide demonstrates or explains the kind of costs that you can get. Staffing costs, so anyone who is working on R&D can be covered, their earnings, their expenses, the national insurance contributions, any pension contributions. About the only thing that's not covered for staff are benefits. And if you have got someone who is only partially working on R&D, then you would apportion it. And obviously HMRC would expect there to be records of that apportionment. Software and consumable items, so things like computer software used in R&D, consumable items such as water, fuel and power, consumable items that you are utilising in undertaking your R&D. Now, to a certain extent, I mean, obviously, if you are looking at sort of software and those kind of developments, then there won't necessarily be consumable items. But, you know, if you are something like a big pharma company, then you are going to be, you know, having materials that you will be consuming. But one of the things that we had with effect from the 1st of April 2023 is that qualifying costs are being extended to include data costs and also cloud computing costs as well. And actually pure mathematics are going to come in as well. Pure mathematical analysis is quite important for the video gaming industry. Externally provided workers, if you are bringing staff online through an agency, doesn't cover payments to the self-employed. It doesn't cover people who are working through their own personal service company, although they may fall under subcontract costs. Costs of running clinical trials, not the general costs, but any payments made to participants, though the general costs might well be covered under one of the other headings. And then we have subcontract costs, which I will touch on a little bit later on. Now, one of the big changes that was supposed to be coming in from 1 April 23 related to overseas expenditure. This has now actually been delayed until the 1st of April 2024, and that was actually announced at the time of the budget. But this is going to have a material impact on R&D claims, because you will only be able to get relief for expenditure which is undertaken within the UK, unless it is qualifying overseas expenditure. Now, qualifying overseas expenditure is a very narrow definition. It's only where the conditions needed to do the R&D are not present in the UK, and it would be unreasonable to replicate it. It is very important to note that that is not the same as the expertise not being available in the UK. And again, I can give you an example from my own experience. I have a client who is a software house. Most of their software programmers live and work in Bulgaria. They were in the UK. Most of them went back home, either because of Brexit or actually because of COVID in reality, but then they didn't return because of Brexit. Now, that is not going to be qualifying expenditure, because theoretically you could get that expertise in the UK. The fact that it would be more expensive and actually it is in limited supply in the UK is not sufficient. If we are talking about subcontracted work, it must be done in the UK. And if we are talking about externally provided workers, they must be paid through the UK payroll. So it is going to be something that for some businesses is going to be particularly problematic. The only example that the Revenue have given in their guidance about the conditions not being present in the UK and not being capable of being replicated is that the R&D it involves needing deep sea diving, and there are no deep sea diving facilities within the UK. And that example makes me think that actually HMRC don't really know what kind of circumstances might apply, but they are going to be very limited. Where we are talking about subcontracting costs, the person or the company that can claim the relief depends on the identity of the contractor and the subcontractor. If you are a small and medium-sized contractor and you are subcontracting to anyone, then the ability to claim R&D sits with the contractor. But where the contractor is large, it is only going to be where the contractor is subcontracting out to someone who cannot themselves claim it, that the entitlement sits with the contractor. So it is quite important to identify who the parties are involved in the arrangement so that you know who has got an entitlement to claim. Now, the actual allowable costs of subcontracting, if you were subcontracting to an unconnected party, you can only claim the uplifted relief on 65% of the costs. If you are a connected party, then you claim either the lower of the actual payment that you make to the subcontractor or their actual costs. If you are an unconnected party, you can elect for connected party treatment, except if it is an unconnected party. In reality, it is probably very unlikely that you are going to be able to find out what the costs are of the person that you are subcontracting to, which means that most unconnected parties will just go for the 65% of the cost that they're paying. You do, of course, and it's always important to remember this, you do get a deduction for the full amount of the costs, but it's just that you are limited in relation to the uplift or in relation to the RDEC, the Research and Development Expenditure Credit, as to what you can claim in terms of that amount. So I think that it is an area which is not straightforward. The other area is if you have subsidised costs. For small and medium-sized companies, they cannot claim under the SME scheme if their R&D is subsidised. Actually, there can be quite a narrow distinction between subsidised expenditure, whether you are subcontracting on behalf of someone else, whether you are doing your own work, and that can give quite significant problems where you have group companies involved, because obviously you have to work out who is doing what work for whom, whether it is subsidised by another group company, whether or not it is subcontracted to another group company, or whether a group company is actually working on their own behalf. And it is a matter of fact whether or not that actually applies. Now, we have had a recent tax case where HMRC have been very aggressive about subsidised costs. Now, in this case, the taxpayer did win the argument, but it was not an easy argument. Let me explain what happened. We had a building company who specialised in renovation work on grade 1 and grade 2 listed buildings. Now, anyone who's ever owned a grade 1 or grade 2 listed building will know that it is an absolute nightmare, because there is a real limit on the work that you can do on the property without breaching various regulations. And so, particularly with grade 1 listed buildings, they often had to think up some very innovative solutions to enable them to do the work that they were asked to do. So, for example, they talked about a situation where they'd had to replace a floor in a grade 1 listed building, and the fact that they had to come up with a solution which didn't mean that they breached the regulations. Anyway, that's really just contextualizing the position that we had. What happened was that when they were quoting for the work, they factored in the costs of the R&D. So they factored in the amount of time and materials that they were going to be using in order to come up with a solution for the problem that they were faced with. And so effectively, the client was paying for the R&D cost. And so the revenues argument was that meant that the R&D costs were subsidised. Now, in the end, the first-tier tribunal decided that this was not subsidised expenditure. And the reason that they said that was because ultimately the end client in that situation was not the slightest bit interested in the outcome of the R&D. They just wanted the work to be done. Typically, when you have got subsidised work, it's where you are getting a grant from someone who is interested in the work that you are doing and will want to see the results that you get from doing the R&D. And the courts basically said if there is really no necessity for you to report back on the outcome of the R&D, then it is not subsidised. Now, the other question that they asked the taxpayer, which was very interesting, was if you'd done a job for somebody involving and you had charged them for the R&D, and then by complete coincidence, somebody came along the following week and asked you to do an identical project, would you charge them the same as you charged the first person? And the taxpayer said, yes, of course we would, because that has now become the price for the job. And so again, that was a way of them actually being able to explain that the client was not really paying for the R&D, it was just part of the cost of the job. But I think it does demonstrate that the revenue are taking a very aggressive line on this point. So the SME relief that we have previously, so for expenditure incurred up to the 31st of March 2023, was an additional 130% deduction that you offset in the computation. From the 1st of April 2023, that is reducing to 86%, sorry, as part of this transition to the new regime. And as an SME, you have the potential to claim a tax credit if you are making losses. And before the 1st of April 2023, that was 14.5%. It is now reduced to 10%, unless you are an R&D intensive company, in which case it stays at 14.5%. But it's really cobbled together if you're an intensive R&D company, because the legislation which is going to retain the tax credit at 14.5% is not going to be implemented until Finance Bill 2024. So next year, and you're not going to be able to claim until next year. So if you are an intensive R&D company, and I should explain what that is, it's somebody who is incurring more than 40% of their operating costs on qualifying R&D, you will have to claim 10% initially if you are submitting a return before the legislation is enacted, and then you will have to make an amendment to that return to claim the additional 4.5% if you are if you qualify. So just good question actually, and in fact both two questions on the same point. If accounting periods straddle the 1st of April 2023, do we treat it as two notional accounting periods? So basically short AP under the old regime and a short AP under the new regime. Yes, effectively you pro rata it, and similar question, do we claim it as a percentage? Then effectively you would, because it's looking at expenditure before the 1st of April and after the 1st of April. So yes, for a computation that straddles that period, you would just be allocating it on a percentage basis. So that is the point. So let's just have a look at the impact of that change. So let's just say that we have a company that incurs £100,000 on qualifying R&D. It says currently, what I mean is that if it relates to a pre 1st of April expenditure, they would be getting a deduction of 130,000 at a 19% corporation tax rate. That would give you corporation tax relief of 24,700. After the 1st of April, that expenditure would be getting 86%, which would give you £16,340 if you're claiming small companies rate, 21,500 if you're paying at the main rate, obviously slightly more if you are paying at marginal rates of tax. So a quite considerable reduction. If you're eligible for tax credit under the old rules, you would be getting £33,350, assuming that that is not capped, which is right, because we always used to work on the basis that you would get, if the whole of your R&D was effectively a loss, sorry, you would get 1/3 of your actual costs back as a credit. From the 1st of April 2023, that will go down to, for expenditure after that date, that will go down to £18,600. So that is at 55% effectively of the previous level, which is a huge hit, because a lot of startup companies that are making losses whilst they are getting underway are going to be relying very heavily on these tax credits to keep them solvent before they start making any profits. So that is a big hit. As I say, this is preliminary though, so hopefully next year we are going to see a regime which will give financial incentives to people to get engaged in R&D. So let's just have a quick look at RDEC, Research and Development Expenditure Credit. I know that this slide says it was introduced relatively recently, but I did think recently, was thinking about this, and it was actually 10 years ago that it was first introduced, although it didn't come in exclusively until 2016. Its level is now 20%, and up from 13% before the 1st of April. And effectively what you get is, as you work out what your R&D is, you get a credit of 20%, which is a taxable receipt, but then you can offset it against your corporation tax liability, or it is repayable where there is no liability, although I have to say that is subject to quite significant rules. Okay, I've had a question come in which says, could you claim expenditure if there's an overseas company which is connected, also does the manufacturing? Now, I'm not sure about that question, because an overseas company undertaking R&D on your behalf is going to be limited from 2024 in actually being able to claim R&D or RDEC. And I'm not sure that manufacturing costs, I suppose manufacturing of prototypes might be something that would be covered by R&D. But I'm not sure that there are necessarily many situations where manufacturing costs are necessarily going to be allowable in the first place. But from 2024, there are going to be problems if you have got overseas expenditure, and that is not going to be allowable. Okay, the other big changes that we've got from this year are changes to administration. And as I said at the beginning, the government are very concerned about abuse of the R&D regime, people being encouraged to make claims where they are not necessarily due. All claims are now going to have to be made digitally, either by submission of a return or an amended return. A lot more details are going to need to be included up front. Full analysis of the qualifying costs, full analysis of the qualifying indirect costs, full details of the R&D and why you feel that you have had an advance in science or technology, what uncertainty you've been tackling and how you've tackled it, all of those kind of things. You will need to provide details of anybody who has advised you to make a claim. So effectively, what the Revenue are trying to do is create a database of situations where they know people are perhaps providing dodgy advice about making claims, and so they can then identify people who had been advised to make a claim by those people. The claim must now be endorsed by a senior company officer. And the big one is that you must inform HMRC in advance, that you are going to make a claim. So effectively, you have got 6 months from the end of the accounting period to notify the revenue that you are going to make a claim. It's not just going to be put in the corporation tax return. The transitional provisions relating to that is that you will not need to make a claim, you will not have to make a notification if you have claimed R&D relief in the previous 3 years. We'll have to be a little bit careful, because if you make a claim for a period before the 1st of April 2023, which is an amendment to a tax return, that is not going to be treated as having been a claim in the previous 3 years. So you need to be a little bit careful about that, and that is going to trip some people up. Question come in, is the admin change for periods ending or beginning after the 1st of April 2023? It applies for accounting periods beginning after the 1st of April 2023. And the except, sorry, actually, let me just check that point if I can. I know that the provisions relating to the additional details come in actually from August. But let me just check the claim. Yes, so the additional detail requirements come in for claims made on or after the 1st of August 2023, regardless of when the accounting period is. All of the other changes apply to accounting periods beginning on or after the 1st of April 2023. I just happen to have my finance bill notes open, so I could check that point. Okay, good. Right, let's move on and just talk about patent box. I'm not really going to talk about this in a great deal of detail because in reality, there are not that many companies for which this is beneficial, although now the main rate of tax has gone back up to 25%, there may be more companies who will think about it. But off the back of the R&D stuff, I did think it was just worth having a quick look at it. It was initially introduced to try and make the UK corporate tax regime competitive, trying to encourage companies to locate high value innovative jobs in the UK. It had to be amended, and it was amended in 2020 because it was vulnerable under what is called the BEPS project, base erosion and profit shifting, which is a thing that's being undertaken by the OECD at the moment, which is the Office for Economic Cooperation and Development, targeting tax avoidance, basically. The original regime basically remains in place, but then it's what's called grandfathered. It remains in place, but there are add-ons. So we'll talk about the basic regime and then we'll talk about the add-ons. So effectively, if you are a company that holds either qualifying intellectual property rights, and we'll talk about what that is in a moment, or an exclusive license over intellectual property rights. So an exclusive license would be a license to exploit those IP rights either in a particular jurisdiction or in relation to a particular product, but you have met a development condition in relation to those rights. If you are also a member of a group, you have to meet what is called the active ownership condition as well, and we'll come on to that in a minute. Qualifying IP is effectively a patent or a patent. I never know how to pronounce it. There are also other things like plant breeders' rights, which are covered, but you have to have a patent, and it has to be either a UK or a European patent. There is no sign that that is going to be changed in the context of Brexit, but yeah, UK or European patent, and we've covered what I mean by exclusive license. So the development condition is basically that you have either created the innovation which has lent to the patent, or you have performed a significant amount of activity to develop it. So basically, this is designed to reward businesses who have been innovative. You couldn't just buy intellectual property, a patent. You couldn't just buy an exclusive license to a patent where you have not been the slightest bit interested in its development and then claim patent box. It does beg the question, what do we mean by significant? And there are some quite interesting examples in the revenues manuals. So, you know, there is, it is a matter of fact what is significant, but it has to really be a material change to, you know, the underlying invention. You couldn't take out an exclusive license to exploit a patent and then just change the colour of it, although I do appreciate that the colour would be unlikely to be patented in the first place. But, you know, it has to be something that is substantial or significant in relation to the item. And as I've said, if you are a group company, you have got to meet the active ownership condition, and that is either that you undertake a significant amount of management activity, or you meet the development condition. And so again, we have got to consider. So this point is that you could have all of the patents owned. If you had a group of companies, you could have all the patents owned by one group company. But that group company has to perform a significant amount of management activity. So they couldn't just be a passive investment company. This is an example from the revenues manuals. Tobacco Limited acts as a supply chain principal for Western Europe for a global tobacco group. Group company in Germany holds the patents and has granted an exclusive license to the UK company. They have an ongoing role in further development and testing of the tobacco technology. They have a head of manufacturing who's responsible for the development work. They fund patent administration costs to protect the technology. They're responsible for manufacture of the product, which exploits the rights and is responsible for the development. So they're not going to have effectively, they're not going to have done enough development themselves to meet the development condition, but what they will probably be able to do is meet the active ownership test under condition A. So they are doing enough in terms of managing the patent to be able to actually be able to claim it. Could I expand on the exclusive license point? Well, it is in some ways relatively straightforward in that there has got to be some measure of exclusivity over the license that you have got. So in this example, we've got a group company in Germany which grants an exclusive license, perhaps for the product in the UK. And so what they would be saying is that we are going to allow you to use this patented technology to produce products for sale in the UK, and we are not going to grant that license to anybody else. If there are different aspects to the patent, you could have an exclusive license to exploit part of the patented item, but you would have to be careful in that situation. So it's basically an exclusive license if nobody else can do what you are doing in the territory that you are doing it. And so it's just about looking at that exclusivity. Hopefully that answers the question. Okay, scenario. Let me just quickly read. Sorry, and that going back to the previous point. Do you also have to meet the development point? Yes, you do. Although, so if we go back onto the previous slide, go right back. If you hold IP rights or you have an exclusive license, then you have still got to meet the development condition. Now, you may not have contributed to the creation of the invention, but you have got to then be developing it to a certain extent. So actually, that is a very good point, and it is one of the reasons why, in many ways, companies don't tend to qualify under patent box, is because they have the license and they are just using the item. Now, if you had the patent, you had a license to use a patented item, and then you developed it to incorporate it into your own product, then that might well be the development point. And I have seen cases where that is applied, but that can be the reason why we don't find that businesses can qualify under this. Okay, let me just quickly read through this. A company had a patent. Part of the redundancy package for one of the employees was that they would take the patent. There were costs involved in transferring the patent. He was heavily involved in using the IP. in the original company, can we claim the patent box relief in the new co, i.e. the company where the IP has been transferred to? My immediate thought would be no, because even though the employee themselves was involved in development of the original item, they would be doing that. In their capacity as an employee of the company. So it would have been their previous company that would have been would be meeting the development condition. Now, if he transfers the patents to his new company, he would meet the ownership condition. Obviously, if he then did further work that was significant in developing the patent, then in that situation, I think he would be able to claim patent box. That would be my first thought. But it is going to be a difficult one, I think. Read the example just given. Is this likely to be relevant to a gin manufacturer who mixes various botanicals to create unique and different flavoured drinks? Sounds like a good client to have. Each recipe is protected and patented prior to commercial production. Yes, so if it is patented, I mean, if each one is separately patented before it is commercially produced, then the manufacturer will own the rights to that that product, and it would seem to me that they would be able to claim patent box on that. Now, this is a slide which tells you about the calculation. Now, to be honest with you, I'm not going to go through this in any detail because I pretty much do a 3-hour lecture on this just in isolation, and we want to cover more things today. But effectively, you look at the income that is being derived from your patent or your patented products. So you take the gross income of the trade, you work out what proportion of that relates to what is called relevant intellectual property income. And then you go through various calculations to get an adjusted profit figure. And then you take the proportion that has been identified here of the income and you apply it to the profits. And there are various tweaks involved in it. But you effectively have this idea that you will end up with a proportion of the profits. Now, what Patent Box does is it entitles you to pay tax at a rate of 10%. And the way that that is achieved is that you get down to your relevant profit from the patent or the patented items, and then you have a formula which reduces that by an amount, which means that you end up paying 10% tax on it. And that formula is obviously now been amended because we have got a change in the corporate tax rates. So as I say, it is a complication. Now, useful question just come in here. Can accessories sold with the product that has the patent be included in the proportion of the relevant IP income? Really interesting question. Thank you for asking that. The answer to the question is it depends whether the accessory is intrinsic to the actual product. So again, there are some quite interesting examples in the revenues guidance, and I would perhaps suggest that it might be useful to have a look at that. But the example I can always remember is there is an example which says that somebody has got a patent over a component within a hairdryer. Now, it's important to note that if you have a component within an item, the whole of the value of the item is relevant, or the profit or the income from the sale of that whole item is relevant intellectual property income. So they incorporate their patented item into their hairdryer, and any income derived from sales of hairdryers would be covered as relevant intellectual property income. If they decided that they were going to package that with a set of curling tongs, I don't know if curling tongs even exist anymore, but anyway, let's just say another item which does not contain a patented element, then only the income relating to the hairdryer would be covered as relevant intellectual property income. Off the top of my head, I can't think of an equivalent item where oh, actually, I can think of an item. Anyone who knows anything about Dyson, I was going to say Land Rovers then, which is not, I mean, Dyson Hoovers or vacuum cleaners, will know that James Dyson always used to boast that every bit of the Dyson is patented. I don't know if that is still true, but it was certainly true at one point. So if you have a Dyson, you will get lots and lots of accessories with it. So lots of things that you can use to clean all the things that, you know, most of us don't clean very often. It could well be that those items are not themselves patented, but if they are fundamental to the use of the product, then the accessories would be covered. So yeah, hopefully that gives you a kind of a sense of that question. So I was wrong to say that it changed in 2020. It actually changed in 2016. And this has made patent box even harder. So BEPS, the base erosion and profit shifting, designed to stop people exploiting using patent box for tax avoidance purposes. So what you now have to do is consider how much, or you've got to multiply the profit from items by what is called the R&D fraction. So effectively, you are only going to be maximizing the amount of profits on which R&D can attract if you have done your own R&D. So basically, you look at your R&D qualifying costs, and you also look at the amounts outsourced to independent third parties. So any work you've done yourself, or anything you've subcontracted to an independent person, is multiplied by 1.3 and is the top bit, and then the bottom bit is those two figures plus any costs of acquiring IP, and then any costs outsourced to other group companies. So if we look at an example of this, company develops a patented widget, they're always widgets. The expenditure to develop the widget is 100. They outsource £40 of it to an R&D subsidiary in the UK and £50 to a third party in France. And they then identify that the revenue from the sales of that widget are 1,000. So the calculation would be total R&D costs are 100. 10 plus 50 times 1.3 divided by 100. So the 10 is the cost they've incurred themselves. The 50 is that's outsourced to a third party in France. Multiply that by 1.3 because that's what they tell us to do. Divide it by 100, times it by 1,000, and basically the income that would qualify under patent box would be £780. So there would be a restriction on the amount of income that you can cover by patent box. One of the big problems is tracking and tracing your R&D and being able to link it to the actual work, the actual patent income that's being derived. Now, thankfully, this does only apply to patents that are granted after the 30th of June 2016. But I do know that there were some very large companies who almost gave up on patent box because of the requirements to do that work. Now, as I said, part of that was because the difference between a 19% and a 10% tax rate, whilst relevant, was not necessarily fundamental. Whereas the difference between 25 and 10, if you're paying the main rates of tax, might make it feel a little bit worthwhile. Okay, so let's move on and talk about share schemes. To a certain extent, using the title of share schemes is slightly misleading, because what we want to do is look at situations where businesses might be wanting to offer shares to their employees, and that might be by way of a share option, an option to acquire shares in the future, or a direct issue. Now, if you have got the opportunity, or you want to offer the opportunity to offer shares, there are approved schemes can apply to employees and directors. Now, all shares given to an employee are going to be employment-related securities. And there are huge amounts of anti-avoidance provisions, mainly because of the creative use of shares in the past to avoid tax and national insurance contributions being paid. Now, I think time for another poll. Could we have the second poll put up, please? Can you ever issue shares to employees without a tax charge arising on the issue? Yes, no, or depends. Okay, I think we can finish that now. Let's have a look at the results. Yes, the answer to the question is, well, you can give shares without a tax charge arising, but it does depend. So yes and no are probably the right answers in this one, but that's what we're going to look at now. So thank you for that. Okay, so the first thing we should know is that actually the legislation talks about securities. So it can apply to things like loan stock, debentures, and so on. But in reality, we are going to be typically looking at shares. I suppose securities might be something that you could look at. Applies to any securities acquired by reason of the employment. And that can include either former employment or prospective employment. Now, there is one exclusion. So if you have shares being given from one individual to another individual, where that is being given by virtue of a personal or domestic relationship, then that can be done without a tax charge arising. So if you've got a mum and dad who've got 50% each of the shares in a company, and their two kids are coming in as employees, and they decide that they want the kids to have some shares, if you transfer shares to the children, notwithstanding the fact that they are employees, if it is by virtue of personal or domestic relationships, then it would not be caught, even if they pay less than market value for the shares. It is important to remember, though, that that does only apply where shares go from individual to individual. In that situation, you could not get the company to issue new shares to your kids, because there would then potentially be employment-related securities arising. So, in broad terms, and the technical reason is on the slide, but in broad terms, a tax charge, oh, actually, let's just answer this question first. Is it true to say by personal relationships we are talking about blood relative or spouse, rather than thank you for being my friend over all of these years? Again, really interesting question. I think the revenue would be skeptical if you were saying that you were giving somebody something simply for years of friendship, because the revenues argument in that case, I think, would be, well, are you giving shares to all of your friends? So I think that you could have a situation where you could make an argument about personal friendship, but I think you would always have to acknowledge that there is a risk. Obviously, if you had someone who was in a common law relationship, where they're not formally married or in a civil partnership, that kind of personal relationship outside of a blood relative or spouse, I think you would be okay with. But I think you would have to say, if it was just about friendship, particularly if that friendship has developed by virtue of that person being an employee, I think there would be a risk involved. Someone said, so that exclusion only applies to existing shares and not new shares. Well, what you could do is you could make a bonus issue of new shares to the existing parents. In the example that I gave, the parents, you could make a new issue of shares to the parents and then get them to gift to the children, but you cannot make a direct issue of shares to the children in that example. Okay, oh, right. If you were giving shares to an employee who was, say, 60 years old, an unconnected person, and they plan to retire at 62, would the shares issued be seen as part of the retirement package? Well, what you could do, I suppose, is to give them an option to acquire shares at the point that they retire, and then give them those shares as part of the retirement package. Actually, one of the things about someone who is retiring is that you still have to consider whether general employment tax principles apply. And so they couldn't be treated as, part of a termination payment because they are taxed under the employment related securities provisions. So that I don't think would work. Okay, so the tax charge for employment related securities is basically the difference between the price that the employee pays and the market value. But it isn't that simple, because there are too many ways to mitigate the tax charge by manipulating the market value. And that is where the basis of a lot of the anti-avoidance provisions come from. So I'm going to look at the anti-avoidance provisions and mainly the restricted securities, but I'm just going to have a look at this slide first, because one of the ways in which it is possible to legitimately reduce the value of shares at issue is by having growth shares. So basically what you do is you would issue a new class of shares which don't have any rights to current value, but only to future value. And therefore you can make a legitimate argument that the valuation of the shares now is low. You have to be really careful to make sure that you have a very robust valuation about the current value of the shares. And it can be quite problematic to sell this to your employees, but it can be quite effective. So I suppose the point I want to make is that there are legitimate, you have to be careful, but there are legitimate ways to reduce the shares which are not caught by the anti-avoidance provisions, which can be effective. Okay, look, it is now 10 o'clock. And actually, before I start talking about the anti-avoidance stuff, it's quite a good point to have just a 5-minute break. So I will come back on probably just after 10:05, given that I need to go downstairs and make myself a cup of tea and have a comfort break. So I'll be back online just after 10:05. Any questions you think about in the meanwhile, please pop them into the Q&A box. Okay, let's get started again. So, as I've said, lots of anti-avoidance provisions. Restricted securities is probably the one that you will be most familiar with, and the one that I'm going to talk about in a bit of detail. But there are also provisions related to convertible securities. So that is where you have got shares which don't have a great deal of rights, but then you can convert them into shares that are more valuable. Shares which have been artificially suppressed in value. Note here that growth shares don't count because they haven't been artificially suppressed. shares which are issued at a low value, but then something is done to artificially enhance the value. Shares acquired at less than market value were not caught by general legislation. Securities disposed of for more than market value. Now, actually, this is something that I do see, and I'll talk about that in a little bit more detail. And then there's a kind of an all-encompassing one, which is post-acquisition benefits. But again, that is not something that we see very often, but I will touch on that in a moment. So restricted securities is the big one, really, because it's the one that has the greatest impact from a commercial perspective. Because the easiest, if we are saying, as we were before the coffee break, that the easiest way to reduce the value of shares is to reduce the tax charge, is to reduce the market value, then one of the ways that you can do that is to restrict the rights associated with the shares. So one of the things that you would do that is perhaps make them subject to forfeiture. And one of the biggest problems that we have with the restricted securities provisions is that you may be imposing restrictions for commercial reasons, but there is no motive test involved in this. So if you are putting restrictions on your shares for commercial reasons as opposed to tax avoidance reasons, then you are still potentially caught. So restrictions are, or the restrictions that are caught are where there is a transfer, reversion or forfeiture of employment. There could be, transfer, reversion or forfeiture of the employment related securities on a happening of a specific event. Any restriction on an ability to retain or dispose of your shares or to retain the proceeds of sale, or any other restriction which reduces value. Now, not all restrictions do reduce value, and not all restrictions reduce value by a great amount, but that's what you would be looking at. Partly paid shares which are forfeited, which can be forfeited, aren't covered. A clause which says that the employee has to dispose of their shares if the employment ends through misconduct also wouldn't be covered, unless that clause is only put in place to try and avoid tax or national insurance contributions. So you couldn't put a misconduct clause in simply to be able to ignore it from the perspective of the valuation, but again, not something we see very often. So how does this work in practice? So firstly, there's this really weird provision which says that even if you pay less than the market value for your shares, if they are subject to forfeiture or similar, and they're going to cease to be restricted within 5 years, then you don't pay tax when the shares are first issued. But that doesn't mean to say that there is that's a specific provision. That's not necessarily going to be very helpful, because as we will see in a moment, all you're going to be doing is pushing the tax charge down the line. You can elect for that to be disapplied, and most people would do that. But where you have got restricted securities, basically you are using the actual market value, so the restricted market value. So the point here is, I suppose, let's just give an example. Let's just say you've got shares that, just normal vanilla shares without any restrictions, are worth £10. You want to give those shares to your employees, but they don't want to pay for them. If they don't pay for those shares, then there's going to be a tax charge at the point that they're issued of £10 per share. Obviously, depending on how many shares you're going to give them, that could crystallise a tax charge which they're not going to be very happy to pay. If you put a restriction on those shares, you might suppress the value, and therefore you might reduce the tax charge. So you might put restrictions on the shares which bring the value down to £3 a share, and then they will only pay on £3 a share, and that might be more palatable for them. Having said that, it's actually quite difficult to put a level of restrictions on shares which will reduce the value to that extent. Most of these are fairly small amounts, but there is capacity for, if you have got very valuable shares, to have a big impact from an absolute perspective. The point is that if you have got restricted securities, what you then get is a potential for an income tax charge to rise where there is a chargeable event. So what you'd normally be wanting to do with employees is give them some shares for a very low initial tax cost, and then get them to help you grow the value of the company to the extent that it is valuable. You all sell your shares and they get taxed on the uplifted value to capital gains, which currently is considerably less than income tax. But what the restricted securities provisions do say, well, if you've artificially suppressed the market value initially so that you have paid less tax, when we have a chargeable event, and we will see in a minute what that chargeable event might be, then some of that profit is not going to be taxed at capital gains, it's still going to be taxed to income tax. So that's what this is doing. There are some exemptions to this, but they are very rare. So 3 situations where there are chargeable events. The first is where the shares cease to be restricted. So you lift the restrictions. The second one is you vary the restrictions. So the shares are still restricted securities, but they're different so that the value goes up. Or the shares are disposed of for consideration whilst they are still restricted. So if you have got forfeiture provisions on your shares which are still in place at the point at which the shares are sold, then you could have a situation where part of the consideration is still going to be taxable as income tax. So the formula for calculating the charge is complicated and is shown on the slide. But actually, what we've got to do is look at effectively, there is an easy way to think about this formula. What you do is you look at the amount that was not taxed initially. That is what is called the initial untaxed proportion. And then you look at whether or not after the chargeable event there is any proportion that is still uncharged because there are still restrictions. So if we look at, and that is explained on the next slide. So let's just have a look at a very simple example and then you can have a go at one. Let's just say you have got shares that are worth £5, but you impose restrictions such that they are only worth £1. And the employee pays £1 for them. So there is actually no tax charge arises when they are issued. When those shares are issued, 80% of the value is untaxed. Let's just say we roll forward and those shares are sold at a point when they are worth £20. Now, normally what we'd be saying is acquired for £1, sold for £20, there's a capital gain of £19. But actually, because 80% of the value was not taxed initially, 80% of that £20 is going to be subject to income tax. So basically, £4 of that is going to be a capital gain, £16 of it is going to be income tax. So what you will end up with is a £16 income tax charge per share and a £3 capital gains tax per share instead of getting £19 subject to capital gains tax. So that's how it works. Now, I'm just going to let you have a little bit of a go. So if we could have the next poll put up, please. So let me just move that out of the way. Shares are required for £7 when the unrestricted market value would be £10. So 30% of the value has not been subject to tax. And then after 18 months, the company is sold for £20 per share. So assuming that the employee has 5,000 shares, so they are going to receive £100,000, how much of that is going to be subject to capital gains tax? 65,000, 50,000, nothing, or 35,000. If you can't do this in your head, don't worry about it. I would probably be the same. Okay, let's end the poll there. Oh, 43% of you got the answer right. That is good. £35,000 is the right answer. So thank you for that. Okay, so let's have a look at the next slide, which tells us. So 30% of it is untaxed. So 30% of it is going to be subject to income tax. They paid £7 per share originally, so there will be a gain of £35,000. Now, what you can do is put in place an election such that the shares are treated as if they are unrestricted. So in this situation, where you're paying £7 per share, but they're worth £10 per share, what you could do is put in an election, and then your £3 would be taxed up front, which would then mean that you would have 50,000 gain on disposal, but that would all be subject to capital gains tax. It accelerates the tax charge, but it might mean that less is chargeable overall, and that is an example of legislation, the legislation at section 431. Now, there is a disadvantage associated with this, and that is the fact that if you pay on a market value and the value of the shares falls subsequently, you don't get your tax back. And that did happen quite a lot around the time of the credit crunch, where we were talking about shares in banks. So effectively, there are disadvantages. It's a bit of a weird election. It has to be made within 14 days, but it doesn't have to be submitted to HMRC. So, you know, again, it's just something that you have to put in place. As I said, the other anti-avoidance provisions we don't see very often at all. One I have seen in practice is a situation where you issue very, very few shares to an employee on the basis that that mitigates the upfront tax charge, but you have a side agreement which basically says if those shares are ever sold, they will get more money for them. So you issue someone with 1% of the shares in a company, for example, and you say to them, well, don't worry, because if this company is sold, you'll get 5% of the shares, or the sale proceeds, or something like that. But if that's the case, anything over and above the market value of the shares that you actually hold would be taxed as income. So you have to be careful from that. From a practical perspective, is tax payable through self-assessment or pay as you earn? I was actually going to mention this, but I'll come on to that point in a minute, actually, in relation to another slide. Now, unapproved share options. So this is where you give someone the option to buy shares as opposed to just issuing them with shares. Don't really have any advantage over an actual share issue, other than you don't pay tax until the point at which the shares are actually issued. And so what you sometimes see is exit-linked unapproved share options. So you would grant an option to somebody to receive shares that they can exercise if the company is ever sold. But then what is going to happen in that situation is that the whole of the value of the shares are going to be subject to income tax, or over and above what you're paying for them anyway, and none of it would be subject to capital gains tax. So it really is just a question of, if you want someone to be an employee, to be a shareholder, do you want them to be a shareholder now, or do you want them to just get some proceeds if the company is sold in the future? The grant of the share option in itself is not subject to tax. It is only going to be crystallising when you exercise that option, or indeed where you sell the option. And so in that situation, you may want to consider approved share schemes. One thing to note is that if you are talking, and this may well be put from the perspective of the employee rather than the employer, you may need to, overseas companies cannot enter into approved share schemes. So if you are, say, for example, an employee of a US company, then it's always going to be an unapproved share option scheme. It's never going to be anything else. Now, international aspects of employment-related securities changed in 2015. Prior to 2015, your shares were taxed according to your residency status when the option was awarded. Didn't matter where you'd worked through the life of the option. If you issue someone with shares directly, then they are going to be taxable where they are resident when the shares are issued. But now, with internationally mobile employees, basically, you grant them an option and then that option is exercised. You look at where they have been resident or non-resident during the period where they've held that option. And so some of it may well come into charge to tax in the UK if they have been resident here at any point. I'm not going to go into that in any detail because, again, just not enough time this morning. So employers have to make employment-related securities returns. It's what used to be called the old Form 42, but now it is all done online. They are hideous things to fill in online because they're basically just an Excel spreadsheet that's got about 100 columns, because so much information could potentially be included. If you have got options in issue, you have got to make returns every year, even if it is a nil return. If you've issued shares, you don't have to then make subsequent returns. But if you have got options in place, you have to keep making returns. And so there are commonly problems. There are some exceptions. So, for example, if you are issuing shares to found shareholders, HMRC acknowledge that they are not employment-related securities and you don't have to make a return. But they are concessionary only, and there are not that many of them. And you do have to be quite realistic about when HMRC might argue that things are employment-related securities. So we had a question about when the tax is actually payable on employment-related securities. And particularly if you elect under Section 431 to have the shares treated as if they are issued at full value rather than restricted value. It depends on whether your shares are what are called readily convertible assets. So if you have got shares in a listed company, that is automatically going to be a readily convertible asset. And so that has to be payrolled. If it is an unquoted company, which a lot of entrepreneurial businesses will be, then it does not have to go through pay as you earn. The value has to be put on the individual's self-assessment return. Now, there are one or two wrinkles, because there are other situations where shares can become readily convertible assets. So, for example, if you had, as I was talking about before, an exit-linked share option plan, where your employees can only exercise the shares when exercise the option, sorry, when there is a sale proposed. At the point of sale, those shares will be readily convertible assets because there is a market for them. So they know that they are going to be able to sell them. So even though it is an unquoted company, they will be taxable. There is also a quirk whereby if you have a group structure, so if you have a parent and a subsidiary company, and you are issuing shares in the subsidiary company, those are also they are also readily convertible assets. So there are some situations then that is a problem, that is an issue. Share values discounted for minority holdings for ERS purposes. Yes, that is correct. You can discount them for minority holdings. If you come across share issues which have not been reported on Form 42 or online by the company, is there a mechanism to submit for earlier years? Because it is just submission of a completed Excel spreadsheet, which you then effectively submit to the revenue by email, I can't see any reason why you couldn't do it for earlier years, to be honest with you. I must admit, I don't think I have ever tried to file one for an earlier year, but given the way that it's completed, I would have thought you would be able to. But you have to first register to be able to submit employment-related securities. So on the pay-as-you-earn login for somebody, when you get onto the pay-as-you-earn page for an employer, there is a box that you tick to say that you want to file an ERS return. So I would say tick that and then just see if you can go in for earlier years. Would you ever include the value on a P11D? This is what we were advised by HMRC. I wouldn't ever put the value on a P11D. I would say you've got to complete an employment-related securities return. I don't see any situations where you would ever put it on a P11D. So I think, I'm just trying to think. I can't off the top of my head think of any situation where you would include it on a P11D. It is quite worrying sometimes, the advice that you get from the revenue. I'm not saying it's always wrong, but there are some situations where you do just question what is going on. Anyway, okay, let's just have a very quick look at approved share option schemes. Enterprise management incentive, company share options, save as you earn, save incentives plans. I think for smaller companies, the one that we do tend to come across most is EMI, enterprise management incentive. There are lots and lots of provisions, and basically the option's got to qualify, the company's got to qualify, the employee's got to qualify. The advantage of EMI is basically the tax that you pay is on the difference between the market value at the point that the option is granted as opposed to the point at which the option is exercised. So under an unapproved share option scheme, you look at the difference between the price when the option is exercised and the price you're paying. With EMI, it's the market value at grant. So if someone is paying the grant, the strike price at the date of grant, then there would be no tax to pay. We also get, it says entrepreneurs relief advantages. I mean, BADR, of course, business asset disposal relief advantages, because as we will see later on, you have got to have a 2-year holding period for BADR purposes. But with EMI, you take account the option period as well. And the other thing is that there is no minimum shareholding for you to get BADR on EMI shares. But again, I'll cover that later on. So to be a qualifying option, you've got to be issuing the option for commercial reasons, not for the avoidance of tax. Each employee can't have more than £250,000 worth of unexercised options. Maximum value per company is 3 million, that's unexercised options. They've got to be fully paid up non-redeemable shares. Got to be exercisable within 10 years. There's got to be a written agreement, and the option can't be transferable. To be honest with you, the one that I see the biggest problem with often when I'm talking to clients is the fact that it's got to be exercisable within 10 years. Because often businesses want to make these exit linked. So they want, again, to make them only exercisable when the company is sold. But then if you've got a business plan, which means that you don't really know whether it's going to be sold within 10 years, you've got to consider what is going to happen at the 10-year point, whether you are going to allow those shares to be exercised, those options to be exercised at the 10-year point if the company hasn't been sold by then. But that is just going to be a commercial decision. Company can't be under the control of another company, and it can't control any other company that is not qualifying. So all of subsidiary companies have got to be qualifying, which basically means that the top co has got to have at least 51% of the shares. The issuing, the value of the issuing company's gross assets must not exceed £30 million. The company must have a qualifying trade, which is one which is being run on a commercial basis with a view to the realisation of profit, and which does not consist wholly or substantially of excluded activities. Now, these are the same conditions which apply for EIS and SEIS purposes. And so, given that I'm going to be talking about that in some length in a moment, I will come back to that point when we get to EIS. The employee that you are issuing EMI options to must be an employee of the company. They must work 25 hours or more a week, or at least 75% of their working time. So again, you need to look at that, and the company and the individual cannot have a material interest in the underlying company, which is 30%. And so, as I've said, tax position depends on exercise price. If you are paying less than the market value at grant, then you will have a tax charge on exercise. And you can also have a tax charge arising if there is a disqualifying event. So if for some reason you stop meeting the conditions for EMI, although there is then a 90-day window to exercise your shares, otherwise there is going to be an income tax charge based on the uplift in value after the disqualifying event. You can pick and choose who you issue shares to under EMI, and the same is true of company share option plans. These are discretionary. Company share option plans have not necessarily ever been thought of as being particularly attractive, because the maximum amount of options you can issue are £60,000. That increased in the budget from £30,000. One point to note is that you do have to take account of any outstanding company share option plans when you are looking at the £250,000 limit for EMI purposes. The exercise price cannot be less than the market value of grants, so you cannot issue these at undervalue. And again, you've got to be a director or employee, but this time you have got to actually be a full-time director or employee. So you don't have the flexibility that you have with EMI. You can't have a material interest in the company. And again, that's 30%. Again, fully paid up shares, not redeemable. The option can't be transferable, or either a listed company or a company that's not under the control of another company. There's no tax charge on grant or exercise, and so any increase in value post-exercise will always be subject to capital gains. Somebody's put a question in the chat box. Sorry, can I just remind you to put them into the Q&A? If you don't mind, it's just easier to monitor it. Do all the tax advantages just fall away for EMI options if the gross assets for the group exceed £30 million? Should you still complete ERS returns. Sorry, I did gloss over the whole point of disqualifying events a little. As long as the gross assets of the group are less than £30 million at the time the options are exercised, granted, sorry. If the assets subsequently exceed £30 million, that would not be a disqualifying event. So that would not actually mean that the EMI would cease to qualify. EMI tends to cease to qualify if the company stops being a qualifying trade, if the employee stops being a qualifying employee. So it's those kind of things that would trigger again. But the £30 million figure would apply when the option was granted. And so if you then exceeded it, you wouldn't get a disqualifying event. Share incentive plans are have to be offered to all employees, and they have to participate on the same terms, although some of the shares can be awarded by reference to performance criteria or seniority or similar. It's not an option scheme because the shares are actually awarded, but they are held within the plan by trustees and they can't then be sold. There are different types of shares. There are free shares, there are partnership shares, there are matching shares, and there are dividend shares. Free shares can be awarded for no value, as the name suggests. Partnership shares are where you have been actually, I can't remember what partnership shares are. I do forget, my mind has gone completely blank. Matching shares are where you've been given free shares and then you can subscribe for an equal amount. And then dividend shares are where you can convert dividends into shares. You have to pay for all of the shares except the free shares. And there is a maximum of between £3,000 and £4,000 of shares that can be issued in each category. So no tax arises on the award of the shares, but depending on when you actually sell the shares may mean that there is no tax charge, and there's no charge if you leave as a good leaver, regardless of timing. So bad leavers are where you have been sacked for misconduct and so on. So if you look at the different types of shares, you have got immediate tax charges, typically if you take the shares out within 3 years, no tax charge if it leaves within 5 years. After 5 years, sorry, between 3 and 5 years, there are different tax charges which arise. And as I say, we're not ever talking about huge amounts of money. Save as you earn share option plans are where, as the name suggests, it's got to be offered to all employees. The employees are allowed to save money towards the exercise of their options. Can be issued at up to a 20% discount. And so they pay a monthly amount into a savings scheme. And then after 3 years, they can take the money out and exercise the option and buy the shares. And there are also equivalent good leaver provisions. No tax on the grant of the option. No tax if you exercise the option outside of the 3-year period. And actually the money, you get no tax relief on the money that's been put into the Save As You Earn scheme anyway. The great thing about this is that if you decide that you don't want to buy the shares for whatever reason, you can just take your money out of the savings account and there's no penalty. Right. I'm getting through this, but let's move on and talk about EIS and SEIS. I think we're about on course actually to get to the end when we need to. Right. So venture capital and investing in venture capital schemes is something that in some ways has become quite popular as an alternative to pension funds, although the relaxation on the pension provisions in the budget may well change that. Although I am giving my clients a little bit of a health warning in relation to pension contributions, but because I think that there may be changes if the Labour Party get into power. So there are typically 3 types of schemes that you might be looking at. enterprise investment scheme, seed enterprise investment scheme, and venture capital trusts. I am going to focus on EIS, but let's just quickly run through sort of the tax advantages of each of those so that we can just sort of do a bit of a compare and contrast. So EIS, investing into unquoted trading companies, typically fairly young, high-risk businesses, although not always, very stringent conditions, which we are going to look at in some detail. An individual can invest up to £2 million, although the second million is dependent on the company being what is called a knowledge-intensive company. So you get, excuse me, I've got hiccups. You get income tax relief of up to 30% of the amount that you have invested. I say up to 30% because if you don't have enough income tax, then you wouldn't get the full 30%. If you have got income tax relief that has not been clawed back, there is no capital gains tax if the EIS shares are sold after 3 years. There is a separate relief, which is CGT deferral relief, which allows for gains reinvested into EIS companies to be deferred until the date at which the underlying shares are sold. If you end up losing money on your EIS shares, I mean, nobody invests hoping that they're going to lose money, but if unfortunately you do, then you can convert the capital loss that you have made net of your income tax relief, but you can convert it into an income tax loss and set it off against your income tax liability rather than it being a capital loss. And the shares will qualify for BPR after 2 years. Seed Enterprise Investment Scheme. It was introduced to encourage investment into startup companies. Some differences from EIS, although the rules are similar. The slide says you're only able to invest £100,000 in each year. That's actually changed. I know that I amended the slide after the budget specifically later on, but it's £200,000, not 100,000. Again, still stringent conditions. Income tax reduction of 50%. Gains that you reinvest in an EIS company, you only pay tax on half of them, the gain. And you also get disposal relief. That is also not on the slide. You get disposal relief on your actual SEIS shares. Venture capital trusts are listed companies designed to be investment vehicles for people who want to invest in EIS or SEIS type companies, but perhaps want to spread the risk or don't want to do the due diligence about the companies that they're investing in. So these are quoted companies that have to be approved by HMRC. You get an income tax reduction of 30% up to a maximum of £200,000 per year. You have to hold the shares for 5 years rather than 3 years. You get an exemption from income tax on any dividends that are received. And disposal of shares in a VCT are again exempt from capital gains tax. And there is no kind of deferral or exemption if you have made gains, which you then reinvest in a VCT. Okay, so let's talk about EIS relief and look at the eligibility for income tax relief. Relevant shares have to be issued to an individual. Now, at the moment, EIS relief is only going to be available up to the 6th of April 2025. So we have only got another couple of years. Now, there is an assumption that that is going to be extended, but I think it is important to note that that is not inevitable. The individual must be a qualifying investor. The issuing company must be a qualifying company. The general requirements have to be met in respect of the shares. And in particular, we have to meet what is called the risk to capital condition, where shares are issued on or after the 15th of March 2018, and then you have to claim the relief. Now, we will look at the general requirements, but we are seeing a lot of activity from the revenue in relation to what is called the risk to capital condition. So the introduction of this legislation, it does apply for SEIS purposes as well. But the aim was to refocus availability of these reliefs into cases where your investment is genuinely risky. So they only want to give out this tax relief if they feel that there is a genuine possibility that you will lose your money. There are two conditions. It is reasonable to conclude that the issuing company has raised the money with objectives to grow and develop its trade. And it is also reasonable to conclude that there is a significant risk that there will be a loss of capital of an amount greater than the net investment return. Now, the net investment return is the capital growth of the shares and any dividends. It's actually quite rare to find dividends being paid on EIS companies, but it is the risk of loss of capital is greater than the risk of the amount of money is in an amount greater than the amount of money that you might make potentially. So the bottom one is about whether or not something is intrinsically risky. The first one is about whether or not you are raising money to genuinely grow and develop the trade. Now, we're going to have a look at a couple of tax cases in a moment, but in the revenues manuals, they talk about having to consider whether you can prove that there is an objective that you want to increase the turnover or increase the number of employees. In terms of the risk of loss of capital, what are your sources of income and what is the likelihood that those sources will either cease or that you won't receive the income that you think that you might receive? The extent to which assets might be owned or created that could secure financing, the extent to which activities are subcontracted to unconnected persons, the nature of your ownership structure, and how investment opportunities are marketed and whether there are links to other companies. So all of those things are supposed to feed into analysis really of whether or not you can qualify, whether or not you meet the risk to capital condition. Now, we've had two cases where the revenue have taken a case to the first tier tribunal on the risk to capital condition, but the courts have not agreed that that applies. Now, the first one was Inferno Films. Their initial focus was making and distributing a single film, and that was the purpose for which they raised money on under EIS. And the revenue said, well, look, you're making a single film. You have got no plans at the moment to grow the business by, making more films or by, expanding what you do or anything. So what their view was is that you're raising money for a single activity. That single activity is always going to remain fairly self-contained. You're not really ever going to get any bigger because your limitations are this single film. The first tier tribunal felt that that was not the case. They felt that there was evidence presented by the company that their longer term aim was to expand. And so what the company was saying is well, we can't run before we can walk. We're going to make this film. And if this film is successful, we're going to use that money to reinvest and make another film, or make another couple of films if we make enough money. So yes, they had ambitions, obviously the film business is incredibly precarious, and therefore they don't know whether they're going to succeed. And so the first tier tribunal's phrase was that the making of this single film was a realistic starting point with limited resources, but there was ambition beyond that. The second case was about a company called Hoopla Animations Limited. Now, Hoopla Animations were going to create a film, they were making a children's animation program called Daisy Boo and Monkey 2. Now, I can't say I've ever seen it. Yes, they were making this animation. Now, if anyone on the call knows anything about animation companies, you will know that it is very difficult to get people to do the actual animation because it is a very niche role. There is a shortage of people who can do animation, and therefore most of the work is done by subcontractors. So HMRC's view was that this business was not going to be, did not have an intention to grow and develop because it wasn't ever going to get employees and it was not going to get more employees. Now, the fact that this company had got huge ambitions in terms of syndicating this, these characters, merchandising, we all know how much merchandising can earn for these types of companies. I mean, they had plans to take over the world, really. And so the revenue focusing on no employees, the courts found that that was slightly peculiar, and they found, as a matter of fact, that there was still evidence of an intention to grow and develop the business. Now, I should say that in the Hoopla Animations case, they didn't actually qualify for EIS, but for a different reason. But both of those cases demonstrate that the risk to capital condition, firstly, is something that the revenue are challenging, but secondly, it is going to be quite important to have things like business plans, demonstrate your plan for world domination, and so on. So it is something that you must not be complacent about. Now, before we do look at the conditions, the other concept which is important from the perspective of EIS is the concept of knowledge-intensive companies. A knowledge-intensive company is one that has sufficient levels of R&D, being research and development at a level of 15% of the operating costs in one of the last 3 years, or at least 10% of the operating costs in each of the last 3 years. And then you've either got to have a company, the majority of whose business will be derived from the intellectual property that is being created by the R&D, or where the workforce have sufficient qualifications. So have to have sufficient qualifications to do the work that they are doing. Basically, the workforce, the ones doing the R&D, have got to have a postgraduate qualification, and they have got to have a postgraduate qualification which is relevant to the job that they are doing. So you couldn't have a business model where all of your clerical staff or all of your ancillary staff had PhDs in order to meet that condition. I mean, I don't think businesses would ever do that, but that is just something that is worth thinking about. Okay, but we will see where knowledge-intensive companies come into the mix a little bit later on. Okay, so the other thing so the first sort of round, the next round of conditions that we have to meet is that the shares that you are issuing under EIS have got to be ordinary share capital, no present or future preferential rights, wholly in cash and fully paid up at the date of issue, and you need to be careful with the issue date. I'll come back to that in a moment. You've got to be issuing shares to raise money for the purposes of the qualifying business activity, and you have got to be issuing the shares for bona fide commercial reasons. Now, no present or future preferential rights you need to be a little bit careful about to make sure that there are no strange shares in issue to mean that you might have a preference, and there have been tax cases on that particular point. Now, as I say, shares have got to be fully paid up at the date of issue. So I'm just going to ask you another question. Could I have poll 4 up, please? Oh, I don't know if that is coming. Poll 4. Okay. Oh, it's gone again. Okay, so when are shares issued for corporate law purposes? When the share certificate is issued, when payment is made for those shares, when the register of members is completed, or don't know. So perhaps you can just have a look at that. I promise we're going to have a coffee break in a minute. Okay, should we close that poll down? Okay, so various different answers to that. About 40% of people have said when the register of members is completed, and that is actually correct. So well done. So I had a case recently where basically the company secretarial service that this company was using had wrongly showed the issue date for the shares in the statutory records. And so what that meant was that the shares had been issued in inverted commas before payment had actually been made by the shareholders. And so the revenue said, you can't have EIS because the shares have got to be issued wholly in cash and fully paid up before they are issued. Now, the revenue then went on to basically say that you can only legally rewrite a register of members' interests under a court order. And so they would not accept that if the company had not gone to the courts and actually got the register changed properly, they would not agree that the dates, the real date of issue of the shares. And so they effectively refused to issue the EIS 1 compliance certificate. And actually, that was a case about a year ago. I don't know what ended up happening with that because it was somebody to whom I was giving advice. So it is one of those areas where you really do need to be, you can't be complacent about making sure that you get those particular provisions correct. Now, I make it pretty much 11 o'clock. Oh, it's now 11 o'clock. So I think we'll have another 5-minute break. So once again, I'll come back online about 11:05. If you want to ask any questions in the interim, please put them into the chat, into the Q&A box. Right, let's carry on. So people who are investing in EIS and SEIS companies don't have to be resident in the UK, but you do have to have an income tax liability, because otherwise you can't utilise the relief. So the basic conditions are that you are not connected with the issuing company, that there are no linked loans during the period, and that means a loan linked to the investment. I'll come back to the connected with the company in a moment. For shares issued on or after the 18th of November 2015, if you have got existing shares in the company, So if this is a second round of fundraising, for example, those shares have got to have been issued within the previous 3 years, and you must have got EIS or SEIS relief on them. And you have got to be subscribing for genuine commercial reasons and not for the avoidance of tax. So connected with the company is broadly more than 30% of the shares. You can't be an employee. You're not supposed to be a director, but there are exceptions to that. So that, for example, if you are a director, but you are not going to get paid, then or not going to get paid an excessive amount, and you don't become a director until after the shares have been issued to you, then there are possibilities of getting around that, but you do have to be very careful to that extent. The company has got to qualify. It's got to either be incorporated in the UK or at the very least have a permanent establishment here. It must exist for the purposes of a qualifying trade. And again, that is another area that the Revenue are looking at in some detail. And I'll come on to that point in a moment. It has got to meet the financial health condition. So it's got to, from an accounting perspective, the qualifying business activity has got to be carried on either by the company raising the funds or a 90% subsidiary. It must be an unquoted company, meet the control and independence conditions, so it can't be under the control of another company, and it can't control any other companies other than qualifying subsidiaries. Must meet the gross asset and company employee test. The gross asset test is £15 million gross assets before the shares are issued and 16 million afterwards. The employees are 250 full-time equivalent employees, and all of the subsidiaries must be qualifying. So all of your subsidiaries have got to be 75% subsidiaries, unless they are property management subsidiaries, in which case they have to be 90% subsidiaries. So what is a qualifying trade? It is a trade which is conducted on a commercial basis with a view to a realisation of profit, must not be carried on in partnership with anyone else. I'll talk about that. I'll give you an example of that in a minute. Does not at any time during period B, which is 3 years after issue, consist wholly or substantially of excluded activities, and we will look at what excluded activities are in a moment. And substantially in this context means 20%. Okay, case law. We recently had a case involving a company called CHF PIP PLC. This was another company that was established to create a children's television programme called Pip Ahoy. Now, this was another case, actually, where the risk to capital condition was an issue. And in fact, this was a case where the first tier tribunal had some serious doubts as to whether the risk to capital condition was met. But actually, this company mainly failed because it was not trading on a commercial basis with a view to profit. So basically, the first tier tribunal felt that the product, I mean, they were really dismissive of this television programme. Again, another one that I haven't seen, but they were really very dismissive of this television programme. They thought it was old-fashioned. They couldn't imagine that any child would ever want to watch it. And therefore, there is, they didn't feel that it was trading on a commercial basis. But I have to say that the company really, really did not help themselves in the way that they presented the case. So they didn't have a business plan. They didn't really have any coherent evidence to give about what they were intending to do, how they were going to make it profitable, how they were going to change it so that it could be sold. So in the end, it was just not deemed to be trading commercially. Now, one of the things I mentioned before was that you can't be carrying on business in partnership. And I had a case last year where we had a group of surgeons, there were 4 of them, cosmetic surgeons, who wanted to set up a company to provide breast implants, both for cosmetic purposes, but mainly for people who had to have breast reconstructions following things like cancer. So their idea was that they could form this company. They were going to use private healthcare facilities, but it was going to be marketed as a sort of a standalone service. But we really struggled to get advanced assurance from HMRC about whether or not this qualified. Part of that was because they really didn't understand what was going on, but they were very concerned about whether any IP was actually going to be developed and owned by the company. But their main concern was really whether about this business was being conducted in partnership with the private healthcare facilities, because the way that it was presented was that effectively the private facilities would publicise the fact that this service was available and the advantages of utilising this company in order to undertake any similar type of work. But HMRC were obviously more concerned that this was actually more like a joint venture. Now, actually, what was going to happen was that the healthcare facilities were going to be paid a fixed fee for being used to actually perform the operations and so on. And part of that fixed fee, the understanding was that those healthcare facilities would promote the fact that this service was available. HMRC were also very concerned as to whether the risk to capital condition was going to be met. What they were really concerned about was whether this was just about guaranteeing an income stream for the surgeons involved. Now, in the end, they did give advance assurance on the basis that this was going to qualify, but it was an interesting process to go through, and we really did struggle a little. Okay, as we've said at the beginning, there are lots of excluded activities, and we can put a list of them up on the slide. Dealing in land, commodities, futures or shares, dealing in goods otherwise than in the ordinary course of trade. We had a case recently where someone was trying to get EIS relief in relation to a company that was buying horses to raise as bloodstock, and that was found to fall within that heading. Things like banking, insurance, money lending, leasing, legal and accounting services, property development, hotels. A lot of them do have caveats or additional conditions associated with them. So, for example, if you are a company that is receiving royalties or license fees, but it is in relation to intellectual property that you have generated yourself as a company, then that's fine. But you wouldn't be able to buy, copyright, patents, other intellectual property, and then simply receive royalties or licensing fees in relation to that if you haven't actually been involved in the development of the product in the first place. Leasing is again an interesting one, and I had a case recently where we had a company that had been getting, I think had got EIS relief in the past, but the accountant acting for them was slightly concerned that they may no longer be conducting a qualifying activity. So they were creating a robot for use in the chemicals industry. So the idea was that if you were a chemical company and you needed to produce a certain chemical or product you could get this little robot which would then manufacture this for you, so that you didn't actually have to have somebody doing it in the lab. Now, they had been doing this for some time, and they were getting to the stage where they had a prototype that was working, and they were starting to think about how they were going to market it. And they had two options, one of which was to simply allow the customer to use the machine for a fixed monthly fee, or they would themselves use the robot in their own facilities to undertake processing work for their clients, and then just provide. So they were almost going to use the robot themselves to become a manufacturing facility. And we had quite a long discussion as to whether or not, if they were going to allow the customers to use the machinery for a fixed monthly fee, whether or not that was actually leasing. Now, their view was that absolutely it wasn't leasing, because they said, well, you know, the product, we're going to have to go in and maintain the product, we're going to have to put in software updates. But we had quite a long conversation about it. And in the end, I think it was a valid point to raise that it might be leasing, and ultimately it was recommended to them that they have a discussion with the revenue about whether or not the revenue, go back to the advanced assurance division and ask them what they thought. But it is an indication of the fact that these things can sometimes be quite nuanced. Okay, so the general the general requirements for EIS companies. The company cannot raise more than a certain amount of money. And this is where being a knowledge-intensive company becomes relevant, because a normal company can't raise more than £10 million in EIS funding, but a knowledge-intensive company can raise £20 million. The money must be used for the qualifying business activity, and again, you do need to be careful sometimes in relation to that. Shares must be being issued to promote business growth and development. We've covered that one as well. Shares must be issued in what is called the initial investing period, which is 7 years or 10 years if you are a knowledge-intensive company. And the 7 years is broadly measured from the point at which you start trading, although there are some other wrinkles involved in that. There are some other situations where that is different. The individual who is subscribing for the shares must claim the relief, and there must be no pre-arranged exit. So there must be no mechanism by which a shareholder is guaranteed that they can sell their shares at some point in the future. So we'll have a look at some areas where we've seen issues in the past in relation to this, but let's first have a quick discussion about advanced assurance. You can go to the revenue and ask them to give you advanced assurance that this is going to be a qualifying company. This is completely discretionary and completely non-statutory, so you don't have to do it. There's no requirement to obtain. HMRC are not going to respond to speculative inquiries. So if they do not believe that you are serious, if they don't believe that you are genuinely looking in a very serious way at creating a company, then they are not going to respond to you. And it is quite important to just remember that point. I do think advanced assurance is probably quite important in a lot of cases, because the last thing that you want is to be submitting your EIS 1 certificate, which is the process by which you get confirmation from the revenue that they agree that you qualify for EIS. The last thing you want is for them to actually be making inquiries at that point. The way that the process works, for anyone who's not familiar with it, is that your investor cannot claim their tax relief until they have an EIS 3 certificate, and the company cannot issue the EIS 3 certificate until they have submitted an EIS 1 certificate to the revenue, and the revenue have accepted that that is relevant. And the way that they accept that it is, that they agree, is by issuing the company an EIS 2 certificate. So you can't get tax relief until you have actually been through, or the company has been through the process whereby they get the revenues agreement that they qualify. Now, what are the kind of issues that we see, the kind of areas that we have addressed? Some of these we've talked about already. Cash not being paid in full at the time of issue, and we have talked about what we mean by time of issue and where the problems can arise. Now, this one is not really quite as much of an issue as it used to be, but you cannot get SEIS relief once EIS shares have been issued. And so if you are doing a funding round and you're going to allow the first X number of investors to actually invest under SEIS and then the balance under EIS, what you actually have to do is you have to issue the SEIS shares on day 1, the EIS shares on day 2. Very early on in the introduction of SEIS, which was 2012, I think, you had to spend all the SEIS money before you could issue under EIS, but that was removed. Or question come in, what about cash being paid but company not getting around to issuing the shares for a few months? That is absolutely fine. If the cash is paid and then the shares are issued later, then that is not a problem. It's where it's the other way around that you have an issue. Actually, that's quite a good point, and it is probably worth just making the point that shares have got to be paid for in cash, and one of the things that you can't do is convert a loan into share capital. So if the individual has got a loan account outstanding with the company and then that is converted into share capital, that would not qualify for EIS because you are not issuing it for shares, issuing it for cash. But I have come across situations in the past where the company is desperate to get some money in, even though they haven't necessarily gone through all of the formalities of EIS and so on, or SEIS indeed. And so what they do is that they get the money in from the investors, and then, you know, effectively there will be often or sometimes quite a long time before the shares are issued. And the pitfall that you have there is that HMRC might argue that that initial money going into the company is a loan. And so, again, you've just got to make sure that the paperwork is very robust. Does the company need to have a sale to be considered trading, but incurring costs for development of a product to be sold later? That is absolutely fine. When we are talking about qualifying trading and the fact that the company has got to be a qualifying trading company, within the definition of qualifying trading is undertaking R&D in order to be able to undertake a trade in the future. So it would be a qualifying business, even if it is simply just developing a product. And in the case that I was talking about, the manufacturing robot, they had had EIS money, and I think that they had been developing the product for maybe 3 or 4 years. So there was quite a long period of time, but undertaking qualifying R&D is considered to be part of the qualifying trading activity. So that would be absolutely fine. Okay, so no pre-arranged exits. Now, again, we did touch on this. There can be no way in which the investor is guaranteed that they are going to get a return on their money. And I do sometimes see, you know, copies of emails or prospectuses being issued which contain very unfortunate wording about prearranged exits, or about, the fact that there will always be somebody who can buy your shares. And that's not really a prearranged exit, but it is the sort of thing that I could imagine that HMRC would would perhaps question. Claim not made. You have got to make a claim. Now, sometimes you find that people invest very small amounts into companies and they forget to claim the income tax relief, because actually what they've done is invested it in the hope that there will be capital growth and they won't have to pay capital gains tax. But you need to be really careful in that situation, because you won't get your disposal relief if you haven't claimed the income tax relief. The age requirement misunderstood this point about 7 years or 10 years from the date at which you started trading and having to issue shares before the end of that period. Again, I have had one case where there was a little bit of a mix-up about that. Considering the impact of ceasing to trade. Now, even though you have to meet these conditions through a qualifying period, ceasing to trade in itself would not necessarily crystallise a problem with your EIS relief, although there is an anti-avoidance provision, as you would expect, that if there is any suggestion that this was not a proper trade and that they haven't ceased to trade for genuine commercial reasons, then you might have a problem. But overall, it's not an issue. And there is just a huge amount of case law in general terms about around EIS, if you want to have a look at that. Okay, let's move on and just talk about business asset disposal relief and exit planning for businesses. I'm not sure that I'm necessarily going to get through all of this material, but I will get through to do as much as I can. So business asset disposal relief gives us a CGT rate of 10% for qualifying disposals. There is a lifetime limit of £1 million per taxpayer. It was reduced for £10 million. So, with serial entrepreneurs, there are now a lot of people around who have already used up their lifetime limit. Now, that reduced on the 20th of March, and I want to say 2020, I think it was 2020. HMRC are doing a lot of compliance work on situations where there were some transitional provisions to stop people overclaiming BADR. But I've had a couple of cases recently where the revenue have picked up BADR claims and saying that only £1 million should apply rather than £10 million. So again, you may well be dealing with the same yourself. Without BADR, the gain would be taxed at 20% if you are a higher rate taxpayer. So it is a halving of the tax rate. I suppose that there is always a lot of thought that at some point in the future we are going to see an increase in capital gains tax rates. I don't know if Labour is committed to equalising the CGT and income tax rates, but I certainly wouldn't be surprised if that didn't come in. Obviously, assuming that they do actually win the next election, which of course is not necessarily a foregone conclusion. But then BADR might in itself become more relevant. Obviously not as generous as it was before, but that was the intention. HMRC believed that it was being abused. Again, must be claimed as well. Okay, so what qualifies for BADR? I'm sure most people will be familiar with this, but just to go through the basics, it has got to be a material disposal of a business asset by an individual or a trust. Very narrow provisions for trusts, which I will touch on later if I have time. A material disposal is going to be shares in a qualifying company, sale of all or part of a trading business, or sale of assets of an incorporated business after cessation. And then we also have provisions for associated disposals. So this is where assets are held outside of a company or a partnership, where you are selling the asset, and there are particular rules for that. There are special provisions for partnerships, and we are looking at trading businesses, but don't forget that things like furnished holiday let property also qualifies, assuming that you qualify no geographical restrictions. So business assets held outside the UK can qualify, again, assuming that the relevant conditions are met. And then there are some specific anti-avoidance provisions. So, for example, you can't get BADR on transfer of goodwill from an individual to a company in which they hold shares. So, you know, again, just be aware of that, and I'll touch on some of those things if I can. So, I suppose if we're talking about entrepreneurial businesses, we are probably going to be talking about sale of shares in limited companies rather than unincorporated businesses. And there are a series of shares of conditions that you have to meet, and you have to meet them in the 2 years up to the date of disposal. Don't forget, as I mentioned earlier on, one of the great advantages with EMI shares is that you take the period that the option has been held into account as well. So in the 2 years, either up to the date of cessation or up to the date when you dispose of the asset, it must be the vendor's personal company, it must be a trading company or the holding company of a trading group, and the vendor must be an officer or an employee of the company. Qualification conditions are not linked to the shares, they are linked to the company. So there are some planning possibilities meant. So, for example, if you have a company that has been the vendor's personal company for 2 years, and we will look at what that means in a moment, then if they newly acquire shares or shares which don't qualify in isolation, then they would still be covered by BADR. So the two examples that I always give is that if you've got somebody who has voting and non-voting shares in a company, but they have, you know, 50% of the shares, it's just some of them are voting, some of them are non-voting, it would be their personal company. The disposal of the non-voting shares would also be covered by BADR, even though the shares don't qualify in isolation, as we will see in a moment. Equally, if you had, say, a husband and wife who both had shares in a company, but the husband wasn't a director or employee of the company, but they were going to sell it, assuming that the wife had available BADR limit, then you could transfer the husband's shares to the wife, and all of those shares would then be covered by BADR, even if the wife hadn't held her husband's X shares for 2 years. So there are some planning possibilities involved. So to be an individual's personal company, I'll come on to that question in a minute. To be a personal company, an individual has to have at least 5% of the ordinary share capital and at least 5% of the voting rights in a company. So somebody who just had non-voting shares in a company would not qualify. And then, now those two conditions have applied since BADR was introduced as Entrepreneurs Relief all those years ago. Since 2018, we have had 2 new conditions, and that is that the individual must be beneficially entitled to at least 5% of the income profits available for distribution to shareholders, entitled to at least 5% of the assets available to equity holders on a winding up. However, there is an alternative to those 2 conditions. You've always got to have 5% of the ordinary share capital and 5% of the voting rights, but as an alternative to the 5% income and assets, you are entitled to at least 5% of the proceeds on sale, assuming that the shares are disposed for a consideration equal to market value. So that is to get round the alphabet share type situation, because someone with alphabet shares is typically not going to have automatic right to receive any income products available for distribution. The other point to note is yet again, if the shares are acquired under EMI, then they don't have to, you don't have to meet the 5% test because all of the shares qualify. So again, that is another reason why EMI can be quite attractive. What do we mean by ordinary share capital? Well, it's a share capital other than capital, where the holders have a right to a dividend at a fixed rate and no other right to share in the company's profits. So if you have got fixed rate dividends but nothing else, then you're not going to be, it's not going to be ordinary share capital. Has been applied very strictly by the courts. There was a case called Castledine where there were deferred shares. They were really weird deferred shares. I was just trying to think exactly what the circumstances are. They were really weird deferred shares. Basically, the question was whether those deferred shares were excluded from the ordinary share capital. Now, the reason that that was relevant was that if you took the deferred shares into account, Mr. Castledine had just under 5% of the shares, and if you ignored them, he had over 5% of the shares. Again, you have to be careful by looking at all of the share rights. There was also a case where the the fixed rate dividend provisions were looked at very closely, and so I would recommend that you look at that McQuillan case if you do have any question about whether shares are ordinary share capital. The second test is that the company has got to be a trading company or the holding company of a trading group. The definition of a trading company is one that we are all very familiar with. It has got to be wholly trading other than activities that are not substantial. And substantial in this context is supposed to mean 20%. Of course, the then big question becomes 20% of what? That would normally be judged according to turnover, profit, time spent, assets, all of those things. It's not always a straightforward numerical test, and the courts have perhaps been quite critical. And there was a case recently involving a taxpayer called Allen who suggested that the 20% limit was actually quite unhelpful. Actually, I've taken out that next slide about activity. I'll come on to that in a minute. Holding company of a trading group. If you have a trading group and you're looking at the shares of the parent company, basically you look at the group as if it is one big company. Now, one of the big issues that we have is about cash. And if you have a company that's got surplus cash in it, there is a question about whether or not the long-term retention of earnings within a company as surplus cash moves that cash from being a trading activity to an investment activity. And this is where the question of activity arises. Traditionally, it has been considered that if you have money in a bank account that's not earning you any interest, however large that is in relation to the total value of the company, that would not be an activity because you're not doing anything with it. But it is quite important to suggest, to note that the revenues guidance suggests that even money that is not being actively managed can represent a trading activity. Now, one of the things that you can do with the revenue is ask for clearance as to whether a company is a trading company. And actually, at this point, I'm going to put in the final poll, if you don't mind. So this basically says, would you ever seek clearance for trading company status for BADR purposes? And the answers are yes, no, and maybe. Okay, we'll just close that down. Yeah, interesting split. Thank you for that. And can I just say at this stage, thank you for participating in the polls. It's always nice to get some feedback at certain points. So it's a really interesting point. So the issue that arises is that if you write to the revenue and ask for clearance that a company is a trading company and they come back and say no, and they won't typically enter into discussion with you about it, but if they say no, when you disclose, if assuming that you do then sell the company, if you do claim the BADR on your tax return, you have to notify that you have claimed it on the basis that contradicts the clearance received by the revenue. So you effectively have to fess up to the fact that they disagree with you, which is almost inevitably going to mean that you have an inquiry opened. If you think you have got a good argument and you don't go for clearance, you can claim the relief on the tax return, and then maybe HMRC will open it up for inquiry, maybe they won't. And actually, they don't open up very many cases for inquiry under this particular test, even though they make a lot of song and dance about it in their manuals. Now, I am not a fan, in general terms, of tax planning on the basis that HMRC don't notice what you've done. But given that they are starting to reject these clearances more often, I do think you do have to weigh up the risks. Now, obviously, you can't claim BADR on your tax return if you have a situation where you really don't think it's due. So again, you can't tax plan on this basis, and I'm sure you all know that. But where you think you've got a good argument, I do wonder whether there is any merit in going for clearance, but you know, it's an interesting point. So the final condition we have is whether someone is an officer or an employee. Whether someone is an officer is a matter of public record. And the question that I was asked a few minutes ago is a non-executive director not on the payroll considered to be an employee? No, they're not an employee, but they are an officer. And the thing about someone who is an officer is that they actually don't need to be paid. So effectively, you don't have to pay an officer for them to be qualifying. Again, going back to points we have already made, we need to make sure that there is no complacency because HMRC do check the public record. They will check on Companies House as to when somebody has resigned as a director. And I had a case where somebody just put the wrong date in and the revenue did pick it up. Although it's difficult these days because you can't alter the Companies House record more than 14 days retrospectively anyway. So I think, and I don't know whether that's always been the case, but I was doing some work for a company that I'm involved in and wanted a backdated director's appointment and I couldn't do it. So it may well be that there is less chance that you can do it these days. Whether someone is an employee is a matter of fact. Now, in that situation, the question of payment might be relevant. Certainly if you are arguing someone is an employee but they are not paid, then that would be a different issue because obviously it's a national minimum wage failure. Some leeway even if a P45 is issued, but you have to be careful. The reason I mention this is that I had a case where a company was being sold. One of the employees had a small number of shares in the company, though enough to qualify for entrepreneurs relief as it was then. The company accounting date was the 30th of April, and the sale was going through on something like the 8th of May. And the lady who worked in the payroll department thought it would just be a lot easier if everybody got their P45s on the 30th of April at the end of the accounting period. And so she issued the P45s on that date, and the revenue came along and said, well, the person who'd been an employee was not entitled to entrepreneurs relief because she was no longer an employee at the date of sale. But we were able to prove that they had carried on working right up to the date of sale, and therefore that wasn't a problem. One of the points to note about both directors and shareholders, directors and employees, is that if you are an officer and employee, there are no minimum hours requirements if you meet the other conditions. So a couple of tax cases on this particular point. An individual was taken off the payroll but continued to work, and her salary was redirected to her husband. This was a situation where husband and wife had shares in a company. There were actually two couples who were shareholders in this company. They were selling the company, but the purchaser company didn't like spouses working together. And so they took the wife off the payroll. They redirected her salary to her husband, but the courts found, as a matter of fact, that she had been an employee through the relevant time. In that particular case, as in the one that I had, evidence by a third party was seen as being very important. Hurst was a case of someone who'd resigned as a director but continued to provide services, and in that case they were found to be an employee. There was very definitely an employment relationship existed, and so that was something that that was something that was relevant. Okay, I have had a query from someone saying, if you receive a negative response from HMRC following a request for advanced assurance, surely you are able to request a tribunal review. You can't, asking the revenue if there is, asking the revenue for non-statutory clearance is non-statutory, as the name suggests. And so if they say no, you cannot appeal against it. I mean, you might be able to go back to them with additional information, but in reality, they are often very reluctant to enter into correspondence. They don't want to get into a debate. Now, if they open up an inquiry and conclude that BADR is not available, then absolutely you can go to tribunal. But I suppose my point is that if you get a negative response, you've got to disclose it on the tax return if you still decide to claim BADR. And that is materially going to increase the chance that you are going to have that return inquired into. Now, it may well be that once the inquiry goes through, that the revenue accept the arguments that you are making about the qualification, but ultimately you've still had the problem of having to actually deal with the inquiry. So that was the point that I was trying to make. Now, sale of all or part of the business is also going to qualify for BADR, but actually I've only got about 9 minutes left, and so actually I think I'm going to skip through this bit because I think probably it's not something that we would necessarily see. I think probably most entrepreneurs are going to be working through companies, and there's quite a lot of information in the slides if you want to go back and have a look at it. Because one area that we do see real problems with are associated disposals. So this is where you have an asset that is held outside the business, so outside the company or a partnership. And this is something that we do see, business premises held outside a company, personally by the shareholders or similar. You can get BADR on the disposal of an asset held outside a company, as long as it is sold at the same time as you make a material disposal of the associated business. So we'll have a look in a minute at what we mean by that. The legislation also says that it's got to be as part of withdrawal from participation in the business, although in practice that is not something that the revenue really do impose. It is got to be used throughout a period of 3 years ending with the date of disposal or the date of cessation. There must be no repurchase arrangements in place. So basically, you can't temporarily sell your shares or your partnership interest to someone else and then reacquire them in the future. And if we're talking about a company, you must be selling at least 5% of the shares in that company. If you are selling a stake in a partnership, the provisions are slightly different. So one of the big problems that we have with associated disposals is that there are additional computational provisions. Asset only partially used for the business, or asset not used for the business throughout the period of ownership. But the big one is that rent has been paid. So you only consider rent post the 6th of April 2008. You would prorata your business asset disposal relief if less than a market rent is paid. So what you've got to think is that there's kind of a sliding scale. So if no rent is paid, you would get full BADR. If full market rent is paid, you'd get no BADR. And anywhere in between that, you are going to potentially get a percentage. There is an extended definition of rent. So where you have got partnerships involved, it's not going to apply for companies, but just for completeness purposes. An enhanced profit sharing recognition of use of an asset, or where the partner has taken out a loan to buy the asset and the partnership pays them an extra amount for the interest. So you do need to be a little bit careful about those particular provisions. Again, just quickly mention partnerships. BADR is available when the partnership sells all or part of its business, or indeed where you dispose of an interest in a trading partnership. And the associated disposal provisions also apply. In reality, the big issue that you have with partnerships is often whether the asset is a partnership asset. Now, obviously, we've kind of focused on getting BADR when you are selling a business, but you might be looking to get BADR when your business has come to the end of its natural life and you are looking to wind up the company. I think the slides for the webinar have been loaded up into the Q&A box, by the way. We're getting a couple of answers for that. So they have been put into the chat box for you to use. Okay. You might also be looking to get BADR if you are winding up a business. And if you are winding up a company, then you need to be careful that you don't fall within what is called the TAR, the Targeted Anti-Avoidance Provision. Now, if you fall within the TAR, your capital distribution out of the company is taxed as income. So it's an income distribution. So we're not talking about the ADR at all. We're not talking about capital gains tax at all. And I do come across some situations where people believe if the TAR applies that it's still a capital gain, but it's not. So this applies where all 4 of these conditions are met. Host company is wound up. An individual has more than 5% of the ordinary share capital. And then either themselves or somebody connected with them starts to work within the set, or starts up a business undertaking the same activity within 2 years following the distribution, and the distribution is tax motivated. Now, this is very clearly aimed at situations where you have got people phoenixing businesses, where you are operating for a short period of time, you want to wind up and get the money out as a capital distribution, but you're going to carry on in the same business. The issues that we have with the interpretation of this is that activity is not defined. The initial guidance that we have suggests that HMRC are applying this very widely. So, for example, in the revenues guidance, there is an example given where someone was a landscape architect and then retired and started up as gardener. And the revenues conclusion was that was the same activity. Doesn't matter what the new vehicle is for the business, sole trade, partnership company. You're probably going to be okay if you're an employee, but you're not automatically excluded. And if I had a company, I couldn't wind my company up, have my husband set up a company and go and work for him as an employee. So in that situation, I would still be caught on the basis that he's an antique dealer and not a tax advisor. But typically, the one question that we are looking at, often to rely on getting out of this legislation, is whether or not the winding up is tax motivated. This is not always going to be straightforward. And there is also something called Spotlight 47, which was published by the Revenue a couple of years ago. Spotlights are where the Revenue have identified tax planning that is being flogged by businesses. Spotlight 47 covers a scheme where you don't actually wind up your company. What you do is you sell your shares to someone else who then winds up your company. They won't have a capital gain because they will have an acquisition cost equal to the distributable reserves. You will have a gain on which you can claim BADR. But HMRC's view is that that is actually caught by the general anti-avoidance rule, the general anti-abuse rule, and therefore it doesn't work. But again, if you're looking at winding up a company in those kind of situations, then you are not, you're not going to get around the TAR. And so we do need to be very careful about that. There are a couple of examples on the next slide, but I realise now that we have got to 12 o'clock, and so we have got to the end of this session. I have missed out a few of the slides, but hopefully they are detailed enough that you can have a look at those if you need to, and I'm sure that we can pick these up on a subsequent course. Anyway, thank you very much for your time today. I hope that you have found it interesting. I will be back again with Consumer in a couple of months' time. And so hopefully I will see you then. And have a lovely weekend. I'm recording this on a Friday, so have a lovely weekend. Thank you very much. And somebody has said, will we have the recording, as was said at the beginning, but maybe you weren't online. The recording will be available, I think, next week, available to you. So thank you very much and goodbye.